Hi there, Shingirai here again with just an update on some of the factors influencing global markets this week. Firstly, US equities have been continuing their two-day slide amidst the backdrop of Federal Reserve Chairman Jerome Powell coming out and really emphasizing the weakness in economic data and expectations given the current COVID outbreak. US jobless claims came in at a number of 2.98 million versus an expected projection by economists of about 2.5 million, which really just goes to show a bit more on the structural weakness on the back of Q1 GDP for US contracting by 4.8%. The UK economy has contracted by 2% as well, based on a quarter-on-quarter basis compared to the previous quarter. And of course, we see the Bank of England Governor Andrew Bailey also coming out, really reiterating some of the weaknesses in the economy we can expect going forward, and the fact that markets are sort of anticipating some more monetary expansionary policy as well as fiscal stimulus in the UK, without, of course, completely cutting out the possibility for negative rates, unlike his colleague in the US Fed, Jerome Powell, making it absolutely clear that America would not be moving into a negative base rate environment. This would see the FTSE today's trading up down about 3.4%, whilst the Euro Stoxx is down about 3.2%. S&P closed down yesterday 1.75%, and Asia stocks tended to be closing down around 1.1% and more. In terms of the CBAM portfolios, a couple of key ideas that we've been looking at over the past couple of days have been really trying to shave off some of our position with regards to global emerging market debt, which has underperformed high yield corporate debt in the developed markets. So we just shaved our positions on global emerging market debt and really trying to bring that back in line with benchmark asset allocation towards emerging market debt, as well as seeing that emerging market debts, as we've previously highlighted, would tend to underperform in an environment where the US dollar is strengthening, as well as seeing that a lot of emerging markets economies have been quite strained out in terms of COVID reaction, as their debt borrowings have been previously high already from lending institutions such as the IMF. Another thing that we've done, we have sold off some of our positions in European equity in favor of replenishing our cash positions, and generally our belief here is that European equities currently aren't trading at attractive valuation points, and a lot of the main drivers behind European equity for now amidst Brexit uncertainty has tended to be German technology, and just until we see a bit more stimulus coming from the ECB and coordinated government responses in terms of fiscal policies coming off the European equities, we've decided to just shave off a bit of our positions and move that allocation to cash as well. We would be looking for attractive valuation points and strong macroeconomic data to back any sort of investment decisions within this region. Another thing that we've been doing behind the scenes is we've recently shaved off most of our allocation to a global listed infrastructure fund, as we don't anticipate too much spending to be going into infrastructure on the back of the COVID current weakness, and indicators, of course, are that in governments around the world will be looking into re-stimulating the economy through measures such as compensating workers who are out of work, and that's where most of the money that would be being spent by governments currently would be going, rather than implementation of more infrastructure, at least in the short run. In terms of ideas that we're thinking about putting some investments into, we've been looking into some high dividend strategies for companies within emerging markets, as well as considering a bit more allocation towards developed markets high yield, and that would be something that would be looking into to replace some of the allocation that we previously held in emerging markets fixed income. Of course, we'll continue to monitor these and other factors that would possibly be influencing the markets, and keeping an eye on the efficacy of reopening programs and fiscal and monetary stimulus in terms of market recovery over the next couple of weeks and months.